Tuesday. What are the two types of personal loans that we can have? It was the very end of the notes. We had two types of loans. Last couple bullets, last few, like 4 or 5 bullets. What were our two types of loans we could have? On Tuesday's notes, last little section, there were two types of loans. What are those two types of loans? Again. Go look on Tuesday's notes, guys. No, look on Tuesday's notes at the bottom of Tuesday's notes. What are the two types of loans we can have? Tuesday's notes, notes number 1 for chapter 10, not yesterday's, Tuesday's. We'll look at the very bottom of Tuesday's notes number 1 for chapter 10. What are our two types of loans? No, number 2 was Thursday. Unsecured and secured. Okay. And the secured were the ones that were physical property. So those are the ones that we're talking about right now. These loans that we talked about yesterday, the mortgage loans, that is one of the big types of secured. Okay. So when we're talking about loans, okay, secured means there's a physical thing that's attached to the loan. So then they can come take it if you don't make the payments. And unsecured loans are things that don't have physical stuff attached, but they're still loans. So it'd be things like for education. Or crazily, some people have good enough credit that they can get a loan to like go on a vacation, which is weird to me. I mean, you should just save up for a vacation. And then they pay it off when they get back. It's like, well, then why didn't you just save the money in the first place? Okay, so we talked yesterday about mortgages, and that's the primary loan to buy a house. However, there is another kind of loan related to a house, and it is called a home equity loan. Home equity loan. And in a home equity loan, oops, where'd my color go? Blue. It stole my bullet. In a home equity loan, okay, home equity loans are when you borrow against the value of your house, but it's not to purchase the house. Okay. So home equity loans borrow against the value of your home. Okay, value of your home. No, I just want you to be indenting. I like moving it so I have space. I'm trying to keep it on the page. If I can keep it on the page, I will. Okay, they borrow against the value of your home, but it is usually for home improvements. Okay, so that means that You bought the house and you've been making payments on it. The value of your home, which is called equity, okay, which is why it's called the home equity loan. You bought the house for, say, $100,000. You had a loan for $80,000. The difference between those is your equity. It's the amount of the house you actually own that the bank doesn't own. Okay. So as you're making your payments, you are increasing your value in the home and decreasing the bank's in the home. So that over time, you get all the value and they get none because you paid them off. All right. So there are times when you need to have stuff fixed up around the house, some major stuff, like what if your roof got a hole in it and so now you have to replace your roof, which happens, life happens, right? But it's not inexpensive to replace a roof. And you don't have $15,000, $20,000, $30,000, whatever it's going to cost, to replace the roof. And you need to get the roof replaced no matter what. So you can go back to your bank and borrow against that value you have in the home to make these home improvements. Okay? That's one thing. Okay? There is another little bit of type. Okay? It is called a home equity line of credit. Okay? Let's do this. Let's underline home equity loan, because that's like a key point. And I'm going to underline home equity line of credit. That's a key point. Okay, home equity lines of credit are similar to home equity loans, but with a home equity loan, the amount, to pay for the improvements is known. So you go to the bank and you say, I have to replace my roof at $13,000, and you borrow that $13,000. So basically what you did is you paid down your loan, but then now you need to use part of it, so it's moving the loan back up, okay, to make the repairs. Now, understandably, when you do that, it increases the value of your home, because now if you had tried to sell it with a bad roof, you would be getting less for it. So it's a give and a plus and a minus. Now, these home equity line of credit, they are abbreviated. They have a little abbreviation for them. And that is HELOC, home equity line of credit. Home equity line of credit is used for repairs, again, used for improvements, when the specific cost is unknown. Okay, so if you know you have several things to do and you haven't gotten the bids on it and stuff like that, and you haven't, it's going to be thousands of dollars, but we're not sure exactly how many thousand. Okay, they do home equity line of credit. Okay, and the home equity line of credit has a limit. Home equity line of credits have a limit, not an exact value. Okay, so you have a credit limit, kind of like with a credit card. Okay, you have a limit, not an exact value. I know it's going to be in this range, but I'm not sure the exact number. So it's almost like with a credit card. And the other thing it has is you can use it up over time, pay part off, and use it again. So it's like a credit card, but it's linked to your house. So, and it's for thousands and thousands of dollars, and it's intended predominantly for repairs. Things about your house that need to be done. Now, it's not always that you have to fix something. Sometimes you make the decision that your bathroom's not broken, but it's just not the greatest. And so you want to increase the value of your home and bring it up to a more modern look so that when you do choose to sell it, it doesn't look like it was a 1970s bathroom, even though the house was built in 1970. Okay. So your home equity line of credit, you buy stuff with it that are related to the home that are used to improve or repair the home. You pay some of it off. You have another thing you want to do. You have the space again. So it's revolving like a credit card. Whereas the home equity loan, it's a one number, one time, done. You'd have to go get another loan. Okay. Let's see. These types, the home equity line of credit is still considered loan. These types of loans are cheaper than personal loans with lower interest rates, but watch out. If you don't pay them, the lender can take your home. Let me put this all in colors. So you connect them to your home. They're for the purpose of your home. And therefore, if you don't pay them, they can come take your loan home if you don't pay them. Okay. So yeah, it's cheaper than just going and getting a loan for the improvements because it's linked to your house. Remember, we talked about that. The secured loans will always have better interest rate because they can come take the stuff to get some of their money back. Okay. Okay. Now we're going to look at buying versus renting. Buying versus renting. All right. When is it a good thing to be a owner versus a renter? And renting sometimes is necessary, and it's not a bad thing. It's just there's sometimes when it's better to be an owner than a renter or a renter than an owner. Okay. Buying versus renting, things to consider. Okay. These are things you need to think about. First thing, how long will you be living in the area? That's, why is that there? That's supposed to be on the bullet. 1 second, I'm going to move it. supposed to be there. How long will you be in the area? Okay, that's your first thing to think about when you're buying versus renting. Purchase if you plan to stay. No, backing up, purchasing, sorry. If you plan to stay less than 3 years is expensive. Okay, because remember there are all those fees? And you would pay the fees to purchase the home, and then there are fees you have to pay to sell your home. And sometimes you can't necessarily sell it quickly if you're going to have to move. So there are times when if you're going to be living only about 3 years in an area, better to be a renter than an owner. Okay. Okay, is expensive. So best to rent. There. Another thing you have to consider, do you have the down payment? Are down payments small or big? If I say you need a down payment on the house, are we talking about a little bit of money or a lot of money? Well, are down payments a little bit of money or a lot of money? A lot of money, very big money. And maybe you don't have the down payment yet because you usually need 20% of the purchase price as down payment. If you don't have it yet, notice I say yet, better to rent until you do. Rent and save up. Now that means you need to be renting practically with some logic in it. You're not going to want to rent something that's going to use up all your money so you don't have money to save. Okay. And that's something people get into the problem that, oh, well, I'm trying to save up for a house, but there's no way I can. Well, it's because you're renting an apartment for $2,400 a month instead of figuring out how to fit into a $1,800 apartment, you know? So when you're looking at renting, you want to be careful. Oh yeah, they could ask for more than 20%. But 20% is usually, if you've got 20% of how much you want to buy the house for, then you're pretty safe that you can go in and make an offer. Because when you go to buy a house, okay, it's a negotiation. It's not a, I have to definitely pay them that money. Okay. So someone puts their house on the market and they say, oh, I want $350,000 for my home. And you have your realtor, and really good realtors go ahead and do something like check comparable home prices. This is part of the service of them that they give you for paying them their fee. So they start looking around, and all the other houses by this guy's house have sold for like $340, not $350. So then you go back to the guy and say, oh no, I want your house, but I will not pay $350,000 for it. I'll give you $330 for it. So then his realtor goes ahead and talks, and he does some comparables and says, $330 is too low, ask for more. So then they come back to you. So it's like this negotiation haggling thing. You do not have to take the price of the house as it's listed. Unless, here's the thing that happens. Like right now, housing is crazy, and people, I guess, because they're out of work, they're in the mood to move and stuff. So right now it's called a seller's market, which means the seller can go ahead and, within reason, set a price and stick to it, because they know they're going to have 3 or 4 different people wanting that house. So when the market's like that, sometimes you have to be willing to go up with how much you're going to give them. It's called a bidding war. Okay. If the house is a buyer's market, in other words, there's a lot of houses available and not as many people that want to rent, not as many people that want to buy, that's a buyer's market, which means you as a buyer have a lot of options. So then you can go down with them and you can negotiate downward. So it's a negotiation, but you don't have to stick with what they say, okay? But if you have 20% down, you know the range you can go for, all right? And that's the idea. Make sure you have at least 20% so you know the range you can go for, okay? Next question you have to ask yourself, renting versus buying. What is the price of homes compared to the price to rent in the area? Okay. Renting might be cheaper than a mortgage payment and may help keep your expenses lower. Okay. There are times when it is cheaper to rent a house or apartment, because remember, we're not saying renting an apartment necessarily. You can rent houses from people. And like the house next to my house is a rental. So they're renting that house and their rental payment would be cheaper for them than if they tried to buy the house and have a mortgage on it because of how much value the house has in it. So that's what that one's talking about. Okay, next thing to think about are house values increasing or decreasing in the area. Okay, so if it looks like the prices are going up, a lot, you may want to rent until the prices come back down. Okay, because remember, you're buying it. So if you see that, and it happens, I've seen it happen, from one day to the next, a house's value could go up another 5,000 or 6,000 because there aren't that many houses available in the area. It's been built out and stuff. Like in the Bay Area, a lot of times a house goes on the market and it might be on the market for like 1 or 2 days because there's so few houses for sale because there's so many people in so little space. So you might need to rent because the value from one day to the next to buy the house is too much for you. Okay, and you might want to rent for a while. It always happens in a cycle that they'll go up, they'll go up, then they'll come down some, and then they'll go up, and then they'll come down to some. So you just want to be watching, okay? That you start noticing that the trend is that they're not, or they're staying the same. They're not necessarily going down, but they're not going up. That would be like a time to buy, okay? It's reverse if you want to sell, obviously. If you want to sell when the prices are up. If you want to buy when the prices are down. Okay. All right. Next thing. Do you know enough about the area you want to buy in. Okay. What this means is that you might want to rent for a little while in a new area to get a feel for the community. Okay. Before you buy. So you don't get stuck with a home you can't resell. Okay. So unfortunately, there are times and places in cities where people don't want to buy. For whatever reason, they don't feel safe. It's not close to some stuff. You know, there's certain things about where you buy that you want to watch for. Is it convenient to shopping? Is it convenient to entertainment? Is it convenient? You know, these are all things people care about. And there are times when you buy a house, you think it's a good area, and you find out it's only a so-so area, and then it makes it hard for you to resell it. Okay, so it's sometimes better to rent in an area, get a feel for it, so you aren't committed to that piece. Okay, does that make sense? Because rentals are usually for a year. So it gives you a year to get a feel for the area. And you might find out you have some really good neighbors, you have some really good stuff. Yeah, it's close to shopping. Yeah, it's close to entertainment. Yeah, I feel safe at night. I don't have to use bars on my windows. That's kind of a giveaway. You probably don't want to be buying something that already has bars on the windows, because there's a reason the bars are. Okay. But there are times when we're in areas where it's not, you know, sometimes you're in an area and then over time it changes. That's different. But you want to use some logic. And if you're going to buy this really big, expensive thing, you want it to be the best possible big, expensive thing, right? Okay, now the last big thing to consider. What is the amount of security deposit for the rental? Now, when you go to do a rental, it's not just rent. When you sign up, because you're new to these people and they don't know who you are, and because with rentals, when the person leaves, they have to go in and they have to, by law, repaint, and they have to, by law, professionally get the carpets cleaned, professionally get the house cleaned for sanitary reasons between renters. These things have to be done. Those things cost money. So what they do is each person pays a security deposit for two purposes. One, pays for repairs in case things have to be repaired. Like you went and you guys were playing around and you were doing handstands in the living room and you fell and kicked and punched a hole in the wall. That has to be repaired now. And not every renter is equipped to fix it. So when the landlord comes in and you're done with your rent, they're going to have to fix it. Okay. So they do this thing called a security deposit. So when you go to rent, you have to have the first month's rent and you have to have a security deposit. And if you have a pet, you have to have a pet deposit. Those are extra. But at the time when you're done renting, they will come in, they will walk through with you and assess what stuff needs to be done. They'll tell you how much they're going to charge you, and whatever's the difference between what they need to fix it back up And what you gave them in security deposit, you get back. It's a deposit. But it is money that you need upfront when you go to rent. Okay, so those of you thinking about renting soon, you need your first month's rent. Sometimes they ask for a last month rent and a security deposit. So you need to have a sizable chunk of money saved up even to rent. So I know you guys still live with your parents, so now's the time to be saving towards your chance to get out. Okay. So the security deposit, so you have to pay attention because sometimes the combination of rent, first and last month, remember I said that to you, and security deposit are almost as much as a down payment for a house. At that point, you might as well buy. Okay? If you have the money to do a first, last, and deposit on something that's $2,400 a month, you're looking at nearly $5,000 there that they're going to ask from you, at least $5,000, maybe closer to $7,000 for $2,400 rental. That's almost the money to do a down payment on a smaller house. That's the other thing. You do not have to buy this great big house as your first house. Sometimes you want to do something small just to get your feet in. Okay. Okay. Back. No. I want to go back there. Technology. Love, hate. Sometimes it goes right. Sometimes it does not. Probably because I moved it and now it's going to ask me to move it again. Yep. If I want to go back, I got to move it again. You don't. It's just me. It's my thing. Here. Okay. So, importance of homeowners and renters insurance. Okay. I wonder if they got a space here. Okay. Nope, it wanted it together. And then it yelled at me at the same time. Okay, so the importance of homeowners and renters insurance and what they're for. Because remember, we'd already talked a little bit about insurance, right? We've already talked a little bit about insurance, protecting your life and your health, right? Well, now we're going to talk about protecting your stuff. Okay, protecting your stuff. Homeowners insurance. Protects against fire, theft, tornadoes, and other property damage. Okay, so if your house catches on fire and burns down, you have insurance to help you get back on your feet. Okay, often the insurance has pays for living in a temporary location and stuff like that while your house gets rebuilt. If there is theft, someone breaks into your home while you're gone on vacation and robs you. So there's insurance for that. Okay. And tornadoes. What they don't have, oh, another one would be you're in the backyard, you're mowing the lawn, you're not paying attention, the lawnmower gets away from you and hits the side of the house and cracks up part of the house. Getting that fixed. That's all stuff that gets covered under homeowners. Okay. What's not covered under the homeowners sometimes is some extra stuff. So extra stuff like you need extra, insurance if you are in flood area, earthquake area, or hurricane area. Okay. So they make you buy an extra and it's called a rider. It's an add-on. So it's called a rider. This is the title of it. It's called a rider. Okay. Now there are other things you can have riders for. Okay. You can get extra insurance for physical, valuable items like jewelry. Maybe you have some family heirloom jewelry, some that great-great-grandmother brought it over, blah, 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 blah. So it's worth a lot of money. Okay. Not just your everyday necklaces and stuff. We're talking the big ticket stuff. Thousands of dollar earrings, you know, that kind of thing. Okay. Also, heirlooms like antique furniture, things like that. Those are heirlooms. Those are things that they have a high cost to replace. Okay, those are also like antiques. Okay, these are also a rider. Okay, but it's a different rider. It's just, this is for physical things. And you would go ahead and document them. You would take a picture of the item. You'd have the item valued by an expert, and they would give you a certificate on how much it is worth. Okay, and then you go to the insurance company and say, I have a $7,000 necklace. Why you'd have that at your house, I'd have no idea. But there are people that have that, you know. Or I have this antique couch that in order to replace it, it's going to cost a lot of money because it's an antique, that kind of thing. Okay. But all those are extras. All those cost extra. Okay. All those cost extra. Last thing about the insurance for homeowners is the capitalized one. Always make sure that the amount of insurance is enough to replace your home if fully destroyed. Okay. So you can rebuild. Okay. It's recommended that your insurance covers 125% of the value of your home, so that you have some extra to offset the fact that costs of things go up. So when you originally got the insurance, your house was worth $300,000, but now it's worth $350,000. So it's going to cost $350,000 to rebuild it instead of $300,000. So you want to make sure you have an extra. You want to be over 100%. Okay. So that's homeowners insurance. Questions about that? That one's homeowners insurance. Any questions about that? We're going to talk about renters insurance now, which is something that's going to matter more to you guys as you launch out on your own and you have an apartment stuff. Okay, renters insurance. Oh, I did forget one thing. We got to back up. Back up here. It also covers if someone is hurt at your home. At your home. And sues. Okay. So it protects if there's a fire. This is supposed to be the word fire, not first. It protects if there's a fire and part or all the house is damaged. It protects about someone breaking in and the repairs to get it fixed because they broke in and to cover some of the stuff they stole. So it's there to protect your stuff, including the house itself, if someone comes to your house and they're visiting you. And you know, you have stairs in your house and they trip and fall on the stairs and they break something. Your homeowner's insurance would help with their medical expenses. Okay. Because they got hurt in your home. Even if they were the ones that were stupid and like were dancing on the stairs and tripped, they could still choose to try and sue you. So watch out for those kind of friends. But accidents can happen, not that they did it on purpose. So you have the insurance that covers for that. So you're not out of pocket and they're not out of pocket because they're a good friend and you don't want them messed up. Okay, renter's insurance provides protection for your possessions when you rent. So you buy renter's insurance to protect your things and only your things, because it's not your house, you're renting it. They have to get the homeowner's insurance for the house. You are paying insurance to protect your stuff. Okay. But it will cover living expenses if the place you are renting is damaged and needs repair. So it is unlivable. Okay. So say you're renting and you're cooking, and it just so happens that a kitchen fire happens. And the kitchen fire happens, you get it put out, but it is completely destroyed the kitchen, and there's a hole in the wall now to the outside and stuff. That's not a livable place anymore. They have to get that repaired. And so the renter's insurance covers for you to be somewhere else. Okay. Questions about that? We're ending there. Questions about that? turn it in, please. Remember to click turn in on both the document